Welcome to this lecture on financial management focusing on warrants. Warrants grant the holder the right, but not the obligation, to buy company stock at a predetermined exercise price before expiration. Unlike call options, warrants are issued by the company as a financing tool to make debt or preferred stock more attractive. They combine equity and derivative elements. Warrants are issued by the company, have long-term maturity of 5 to 10 years, and exercise price above current stock price. Exercising warrants issues new shares, causing dilution. They sweeten bonds or preferred stock, lowering issuer yields while offering investor upside. Example: a warrant with $50 exercise price and 7-year expiration profits if stock rises to $80. If stock stays below $50, the warrant expires worthless, showing its risk-reward profile. Companies issue warrants to lower bond interest rates, as they make bonds more attractive for lower coupons. Warrants provide deferred equity financing, with dilution only if exercised, offering capital raising flexibility. They attract investors to risky firms with upside, improve distressed deals, and enhance capital structure flexibility. Detachable warrants trade separately from bonds. Non-detachable must be exercised with the security. Equity warrants buy stock, bond warrants buy bonds. Covered warrants use existing shares, naked issue new ones. Exercise price is the set price to buy shares. Expiration date is the last exercise day. Conversion ratio shows shares per warrant. For example, 4 warrants for 1 share is 0.25. Intrinsic value is max. Time value is premium for future potential. Cash exercise pays the price. Cashless delivers fewer shares without payment. Like call options, warrants combine intrinsic and time value. For example, stock $70, exercise $50, intrinsic $20. Warrant market price exceeds intrinsic due to time to expiration, volatility, appreciation, and dilution factors. Dilution from exercised warrants issues new shares, reducing EPS, for example, 10 million to 12 million shares. Warrants and call options both allow buying at fixed price, gain with stock rise, lose to time decay. Warrants cause dilution as company issued. Options are exchange traded. Warrants have years-long maturities versus options months. Warrants fund financing deals. Options hedge or speculate, affecting risk, pricing, and use. Warrants attach to bonds, preferred stock, private equity, venture capital, and restructurings. Warrants let issuers offer lower bond coupons by providing future upside to investors. For example, 6% bond with detachable warrants gives fixed income and equity potential without immediate dilution. Tesla used warrants in private financing. SPACs include them for post-merger buys at set price. Distressed firms use warrants in restructurings to compensate creditors for concessions. Issuer benefits, lower coupons, deferred dilution, flexible capital attracts risk takers. Issuer risks, future dilution, complex valuation, mispricing from volatility. Investor benefits, upside potential, lower risk than stock, leveraged exposure. Investor risks, expiration worthless, volatility sensitivity, dilution impact. Warrants offer issuers lower costs and investors leveraged equity upside, but with dilution, volatility, expiration risks. Understanding warrants aids analyzing financing, incentives, and capital structures. Thank you for joining our lecture on financial management, focusing on warrants. See you at the next lecture.